Hello, my name is Dan Smith and I am the Head of Investor Relations at Carlton Bonds. I'm joined here today by Simon Lenney, Chairman of Carlton Bonds, to have a discussion on a topic that's quite prominent at the moment, and that's inflation. And we'll be looking at it from 2 points. First of all, why inflation needs to be a key consideration for investors in general. And secondly, how or why property should form part of that consideration process. So let's jump straight in. Right now, inflation in the UK is at a 3-decade high of 7%. And if the predictions are to go by, that should actually hit double figures by the end of the year. Now, inflation isn't an inherently bad thing. But right now, Simon, what does high inflation of 7, 8 or above percent mean for investors?
Hi, Dan. Thanks for having me. I think the issue that we're faced here with such a high inflationary rate compared to other market factors is that the disparity between investors' return, which is still relatively low on cash investments and interest rates generally, are not keeping up with the rate of inflation as we see it.
That's a great point, Simon. And I think right now at the moment, if you were to save cash in a high interest savings account, at the moment you're looking at 1.5%, which clearly is well under the current rate of inflation.
Yeah, absolutely, Dan. I think what we got used to, certainly over the last 20 years, is a low inflationary rate linked to low interest rates, both fairly benign, but at the same time, a fairly steady economic growth, and everybody seems to, that's become the norm for everybody. And we're now looking at something that's actually, we'll probably look at something further on where we're considering something that's new for a lot of investors here. 1.5% return on an instant access savings 2 years ago would be considered really high. Now we're looking at inflation that potentially could hit double digits. But we're not going to catch up the disparity between the return on somebody's cash sat in a building society or in a bank against that type of inflationary factor. That's a big gap for somebody to consider.
It is, and you just mentioned something which ties in well to our next slide. But for many investors, this is the first time they will have had to really give any consideration to this aspect of their portfolio. You can see on the graph here that this inflation rate that we are at now we've got there really rapidly in comparison to other peaks of the past 20 years. So even for somebody in their mid-40s now, who may have not started investing until their early to mid-20s, this is the first time they will have had to really consider how inflation is impacting their portfolio.
Yeah, absolutely. Everybody gets used to it. It becomes the norm. We had the financial crisis in the early 2000s, which is, I guess, driven very low interest rates since then. And our way of living is geared around that. If you go back to the 70s and 80s, where inflation was what you would class as potentially the norm at between 4 and 5%, but interest rates were very much in line with inflation, and the Bank of England was able to control to an extent where inflation went, and have an immediate impact by just increasing interest rates. Within 1 or 2 quarters, you would see the impact. Now, I don't think the Bank of England has that opportunity here to control that. There are too many external factors. We know that inflation has been driven initially by higher fuel costs, higher food costs, electricity particularly. But there are other factors that are going to come in, which are going to maintain a higher rate of inflation, where the economies across the globe are starting to react by increasing interest rates. We've seen that in the US this week, but they're not going to catch up. They're not going to be able to control it to that extent. So I think as an investor, you actually have to look at your portfolio and say, what parts of my portfolio can adapt to this higher inflation, and how does that work for me?
What I find interesting personally about property is that it's similar to what you just mentioned, in that it can be agile and it can adapt. So if we look back maybe 20 years, there were investors getting involved because they could quite literally buy a property and maybe over the course of 2, 3, 4 years, double their money. That's not really the case today, but there are a lot of different positives to investing into property. The demand certainly hasn't wavered over the past few years, in particular, given that we've had everything happening, COVID, the war in Ukraine, energy prices, and so on. So what's driving this demand or this resilience over the past couple of years, and what's set to keep it alive over the next couple of years, Simon?
Yeah, I think there's a number of factors, Dan. The pandemic, I think, was a surprise to a lot of us. So we all thought property prices may well crash, and in effect, people were hunting for a different type of product. So we have I think people are calling it the race for space. The change in working practices from being office bound and office based 5 days a week to actually spending more time working from home, not having to have the weekly commute, has driven people to look for a different product. So they're looking for a bigger house, they're looking for a garden, they're looking, good infrastructure links, good transport links, good local amenities, but also the fact that they're going to have to spend more time in this house that they live in. Therefore, they're willing to look for something a little bit more expensive as well. Combine that with lack of stock, then you look at the affordability aspect. It all drives particular areas, and we all know there's always been a hotspot somewhere close to where you live, which has a very well protected growth pattern in house prices, and I think we're seeing that more in the north now than we are actually in the south. We've still got very low unemployment, and I think there are still quite a lot of accumulated savings as a result of people not being able to spend in the pandemic, which will continue to bolster the housing market. And also, with people putting a greater emphasis on a different living style as opposed to lifestyle, then we will see certainly the north, where we are, hundreds of miles away from the capital, but actually, maybe an hour and a half, 2 hours away on the train if that's necessary. Then we can actually, we can look at something that's a slightly different product. And deliver a very good product and a very good living style, which should see house prices across the north increase, certainly over the next 5 to 6 years.
I think this is a great point, Simon, because it also showcases that this isn't just a isolated scenario, or isn't just something that house builders focus on or have picked up on. It's clearly a sector-wide or even country-wide scenario. As you say, you can now travel to the centre of London from numerous different places in the north in 90 minutes, 2 hours. The infrastructure has been developed to actually make that possible. To the train services, internal regional flights. It's becoming much more possible to have a full-time job based in the southeast, but actually live in the northeast or northwest, which just wasn't realistic. Maybe 10, 20 years ago, maybe even less, depending on where you lived.
Yeah, I agree. I think also the fact that we're, the government have a policy of trying to rebalance the north-south divide. and the investment that we're seeing, certainly in and around the northeast, government offices coming into Darlington. We're seeing major investments in South Northumberland and Wearside and Teesside for new technologies, battery plants, and low carbon type investments, which are driving demand for residential property in and around this part of the world and across the north generally.
Yeah, and everything ties in here to the forecasts by Savills, who well, the data on screen speaks for itself. Over the next 5 years, London's forecast to have a 5.6% house price growth. But if you look in the northeast, kind of Yorkshire and northwest, well, we're approaching 20% over the course of 5 years. I mean, I think that alone is a decent indication of the property market and its resilience, and it's clearly its future growth potential outside of the southeast. Yeah,
I totally agree.
So we've touched on inflation, Simon, as an issue that investors need to give or should be giving some consideration to, and we've touched on the resilience of the property markets. When you have these two components together, it can be quite easy for someone to think, hey, I need to invest everything into this asset to combat the high inflation. At Carlton Bonds, we can't offer any financial advice, but I'm confident in saying there'll be no financial advisor who would say to do that. Don't put all your eggs in one basket. Don't go to early stage VC to try and target 10, 20, 30 times, because although that would, if it came off, outstrip inflation, it wouldn't follow that diversified portfolio, which is still one of the kind of main considerations for investing today.
Yeah, I agree. I think it goes back to what we were saying before. I think the gap between current interest rates and inflation is not something that's going to be narrowed very, very quickly. I think there are contributing factors, particularly say from the Ukraine conflict, that will see higher energy costs, commodity prices, supply disruption, and also I think very important for the investor to consider, but the financial contagion that is created in the stock markets. It drives in uncertainty. Its unpredictability means that returns from what you would expect to be your medium and long-term plan within your portfolio potentially are not going to be as high as you would expect. You're absolutely right. We should all have a balanced portfolio, and every financial advisor will be saying that your medium long-term gains are far more important. However, across every portfolio, you should have an element that is dynamic enough to, I guess, adapt towards certain changes that we're seeing here. So your return on your cash investments at 1.5%, or maybe heading towards 2%, if you're willing to tie that up for a 2 or 3 year period, against inflation of potential double-digit growth, they are never going to be matched. I would suggest that if you can find a balance where, as an investor, you're comfortable with an investment that potentially could be property backed and could be providing a higher return, and there's an element of risk that you're comfortable with, then perhaps that is something to consider.
I think that's a great point, Simon, about the risk element, because the higher inflation goes, if you're trying to outstrip it with your investments or your investment portfolio, the more risk that you generally need to give consideration to. So there may be a point for certain investors where it isn't a case of actually trying to beat inflation. It's just about trying to ensure that your capital is at least meeting the rate of inflation, isn't losing funds in cash value.
Trying to alleviate the gap, I guess, aren't you?
Indeed. Simon, it's been as great as ever to speak. Thank you for your time.
Thanks very much, Dan. Very good to see you.